It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the CFPs on the program. With me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
What are the contribution limits for your retirement plan next year? Your 401k, your simple IRA? How about your Roth IRA or your HSA? We've got those answers coming up, but more important than that, what is your overarching tax strategy? That and more this hour of the Wise Money Show.
That's right. And we've got questions from fans of the show that we're going to be hitting later in the program. Special thanks to Auto Owners Insurance for sponsoring that segment. So we appreciate that. You can submit questions to us a few different ways. You can call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show and engage with us and submit questions there as well. Okay, so guys, like Kevin said, one of the first things that you do as you hire a new CFP is you start determining what your tax shelter strategies are. Right. I mean, that is so geeky to say, but like, are you funding Roth? Are you doing Roth conversions? Are you doing HSA? Like, you're going to figure that out. And Kevin, that sort of inspired this, last show or 2 shows ago, started calling it bracketology. Love that. I didn't think you were that cool, Kevin.
It gave me goosebumps. I thought maybe we're into March Madness again. That's one of my favorite times of year.
People underestimate my level of hipness.
Yeah.
But yeah, I am really with it.
So we want to talk about what are our favorite tax shelter strategies to help you think about, which ones you should employ. But this episode is not advice. It is not, because your tax shelter strategy needs to be connected to the other 5 areas of your financial life. Otherwise, it's dumb. I'll just say that. Like
D-U-M, dumb.
Right. Otherwise, it's a bad idea. Right. And so it's got to make sense in your cash flow. It's got to make sense with your protection plan, with your investment planning, retirement planning, and estate planning. So we'll start by talking about tax the contribution limits, and then we'll flow into that. But comments.
Well, I think the interesting thing is when you think about this, there's a couple things that I want to say to set the table. First of all, there's a difference between tax planning and tax preparation.
Sure.
So tax planning is one of the 6 areas of financial planning. That's why, Mike, you're saying when you hire your certified financial planner, what is your tax plan? And I was just talking with a good friend of mine who reached out and said, "Hey, I love the stuff that you guys do, and I'm excited about retirement in a few years. I want to try and be retired at 55. I've got this money at this firm in St. Louis, and what do you think about what I'm paying for it?" And I'm like, "Well, I think you're asking the wrong question. The question should be, how often does this guy talk to your tax planner and your insurance agent?" That, to me, is the question. Because what we're going to talk about today, I hope you don't get lost, because I'm going to oversimplify and say you're in one of 2 categories. You're in the category where you say, "Hey, listen, I've got financial resources, but I don't have enough to fully fund everything that you're talking about. So what should I fractionally fund to get the biggest benefit?" And then you might be in the camp where you say, "Hey, listen, God's blessed me with sufficient resources that I can pay all of my bills, and I've got lots of extra left over, and I don't know exactly where to put all of it." Mm-hmm. And especially for that person, you want to know what are the options and what are the limits, and how do you make them work together?
Well, this is one of the things that I would say almost every really, truly successful family, when it comes to finances and everything, they all have this in common, that they totally take advantage of the tax shelters that are available to them.
Agreed.
This is kind of a subset of your overall tax plan, because you don't want to just throw money into certain tax shelters just because they're there, right? This has to be linked to some broader strategy, some overall game plan for what you're trying to achieve in your life. And certainly you want to match the tax strategies or the tax shelters with the the life outcomes that you're shooting for? What are the goals you're trying to achieve, right? And so, I think it is important. I don't know how often we really dedicate an entire show to just talking about your tax shelter strategy.
Right.
But that's where we're going today, and it's important for you to just stay up to date on what's changing from year to year. And here's what you know. In 2022, some of the rules are changing. You get to contribute a little bit more, but how do you decide what the right amount is and where to put it? That's what we're going to talk about. Okay,
so let's hit contribution limit changes. So 401k, if you're into maxing that out, it's been $19,500. That's your contribution maximum that you can do. If you're age 50 or older, you get to throw another $6,500 in there, so your limit's been $26,000. They're increasing that $1,000. That catch-up contribution staying $6,500, but now everyone can contribute up to 100% of their earnings.
That's the key, right?
With the cap of $20,500.
And you can contribute 100% of your earnings. That's what's allowed. But the reality is, what is allowed is what's allowed by your plan.
Yeah.
Right.
So there are some plans that do not let you do that much. I was just working with a client with a plan. They can only put 50% of their salary in.
That is one of the most frustrating things as a financial planner, when you know a strategy is right for a client and they want to take advantage of it. You want to, it fits in their overall game plan, and yet they're limited by a decision that maybe an employer put in place maybe a decade or two ago, and they just haven't revisited the retirement plan to update it to, I don't know, give maximum flexibility to their employees. So,
no, but that's more rare. When I started in
it is more
the
rare.
world, like when I started in the financial world, it was, common, 25%, whatever,
Right.
something like that. That's very rare now. We're not going to go through all of it because it doesn't apply to so many folks, but I'm looking at the 401k plan limits and how they're different. And, there's higher limits. There's total contribution maximums, which includes your after-tax 401k and profit share and other things. Those limits have increased about $3,000, $67,500 if you're age 50 or older. Kevin, you want to comment on that?
Yeah, I'm going to say that does make some sense, but it's going to make very little sense to most of the folks listening. I think what might be helpful as well to know is with the simple IRA, if you're participating in a simple IRA, your limit was $13,500 in 2020, and it's $14,000 in 2022.
What about the IRA and Roth? Any changes there?
yeah, they didn't change it.
Yeah, I know.
Who knows? I mean, they can always tuck another tax law change in there. But when they went through and were looking at all these contribution limits, they updated the 401k and HSA and many others. But for whatever reason, they didn't allow you to save a little bit more into the IRA.
I knew the reason way back when. I did a Next 5 Step sort of shorty video on this a couple months ago when they came out with these new these new limits, and they increased it like 5% a year, but not. They won't increase it until that threshold is $500.
Yeah.
Here's the problem, though. I don't know if you've looked or gone grocery shopping or if you've put gas in your car, but we've got inflation, and we're starting to see wages increase as well. And so this shocks me that they didn't override the system and allow people to contribute more to Roths and IRAs.
Yeah, I would not win on the Price is Right, but I had someone this morning tell me she used to buy 24 eggs at Walmart for like $3, and now it's $6. So I don't know. That could be true or not true, but here's what we know: that the basket of goods and services that you're buying costs more than it did meaningfully a year ago.
Yep.
HSA contributions are up $50 per person, or $100 for the family. So $36.50 for self only and $7,300 for family plan, and you get that catch up of $1,000. So, okay, that's all the geeky stuff. What are the strategies you need to consider? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. I know what you're thinking. Wow, 50 minutes, that's a long time. I get these comments often. No, what you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time, every Saturday morning, also on podcast as well at that same time. But here's the kicker. It airs on a handful of radio stations in northern Indiana. So yeah, it's 43 minutes, 50 minutes, because that's the airtime we're filling on the radio. And so, but if that's too long for you, that's fine. We've got additional content that we drop all throughout the work week. Next Wise Step videos, 8 to 10 minutes long, taking one financial concept, applying it directly to your financial life, helping you make wise financial decisions. So if you're about that, make sure you hit that subscribe button, turn on notifications so you like the content, and leave a comment. Thank you. All right.
So I said it wrong. I said that it was 13.5 in 2020. I meant to say 2020 and 2021.
Oh.
But the interesting thing is when you look at these retirement plan contributions, they are ratcheting them up, and it's a certain inflation rate, and they only do it in $500 increments.
Right.
But look at the HSA.
Well, right.
Because the HSA is bumped in
$50
$50 increments.
Yeah.
So
they make the rules. They can change their own rules. They
exactly.
can bump it by 1,000 if they want to. But
All right, let's get into strategies. And I've got, what do I have, 5 laid out here that we'll walk through, and then we can add others. So obviously there's an infinite number of them, but I grabbed so that we could talk in some sort of, in a certain direction together. I've got them laid out. So first one is laid out there, still in the first segment. So, all right, what's your tax shelter funding strategy? I would argue one of the most important decisions that you're going to make in your financial life with your CFP. We're going to help you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Go check it out wherever you listen to podcasts. Search the Wise Money Show. Follow us, subscribe to us, whatever. But either way, rate the show. We appreciate that. And leave a comment. Thank you. All right, so we're talking about tax shelter strategies. This one doesn't get that much attention. I don't know, guys. I put it right up there with level of importance as your asset allocation.
yeah,
Pretty close, I think. And maybe the when you retire, like the date you retire, like this is that important. Okay, What is your tax shelter strategy? And the great thing is, those of you that think it's on autopilot and stays the same every year, that's not the case. And you've got to look at this every single year and say, is the tax shelter strategy that I've been using, is it still the right one for me?
I love that you're putting those on the same level, though. The mix of investments that you use to fund your goals and the tax shelters themselves, the buckets that the money goes into, what mix do you use there? Because it will determine not only what kind of tax write-offs you can get up front in this current year, but also what are the different pools of money that you can go draw on when it's time to actually start using these resources to fund the goals down the road.
That's right. That's right. Okay, so we're going to hit some of our favorite tax shelter strategies. And the first one, I love this one. When someone's got enough resources or income, or maybe non-IRA assets. All right, I'll just stop talking. Max fund your pre-tax 401k. So put as much as you can pre-tax in your 401k, and then also max out your Roth IRA. It's sort of getting both sides of the goodies there.
Yeah, so you're saying do a combination of some money that reduces your taxable income up front. That's the traditional 401k or a 403b if you work for a nonprofit of some sort. But then match that also up with Roth IRA, which is already taxed money going into an account that it can grow tax-free. Do you limit this in your mind to just doing pre-tax and Roth together, or what if they were both Roth or both?
No, you certainly can. Again, there's an infinite number of tax shelter strategies, but this one seems to hit a lot of people where you're looking and say, well, right now I have high income, but we have really low lifestyle. Like we don't need that much, and so in retirement, I don't think we're going to need to be drawing a lot out. So hard to imagine we'll be in this high of a tax bracket. Well, then you say, well, if you've got a lot of margin there between your income and your spending, let's avoid taxes today, But then let's continue funding tax shelters. So do full pre-tax and then add Roth contribution.
And the decision-making process for whether you toggle in the 401k between pre-tax or after-tax has to do with where your income falls. Because if you're married and your income falls in the 190 to 210 range, if you're north of that, you are phased out from contributing to a Roth IRA. So therefore, you might want to say, all right, well, let's do a pre-tax. You also might be looking at the child care credits and the child tax credits and say, hey, there's a sweet spot in there that if I'm using pre-tax, I can work my income down to a certain level. So this is the thing. None of these are standalone decisions. If you make one decision, pre-tax or after-tax, into the 401k, there's a cascading effect of all of the other decisions that get made for you. So this is where you want to understand, what decision am I making, and what are the ramifications across my financial plan, and what I can and can't do.
Yeah, I love that. In fact, we did an entire show talking about the different phase outs of certain tax credits and other goodness that could be landing on your tax return. But if your income just creeps a little too high, all of a sudden you can be left out in the cold, not getting some of these benefits. But that traditional 401k is a way to maybe kind of manipulate your income back down, make yourself eligible. And one of them being maybe it suddenly makes the difference between you being able to contribute to the Roth IRA or not. So I love the combination. How you mix that up really is important.
So those are two use cases for that one. Current trends, I see fewer people doing that right now because we're all sort of watchful for higher taxes and aware of RMD with how markets have run up. So I do see more people, Josh, sort of max funding the Roth 401k instead of pre-tax. But those two use cases that Kevin and I brought up, there's no difference there. I mean, those still very, very applicable there.
And I would like to chime in just as the old guy in the room. So I've been doing this for 28 years. And my whole career, we've been worried about two different boogeymen. One is the boogeyman of, when I get into retirement, I'm going to be paying higher taxes in retirement than I was while I was working. That, for most people, is just not true.
Right.
And then so this is that should factor in, and thinking, hey, look at how much we are spending as a country. For sure, they've got to raise taxes. For my entire career, all they've done is lower taxes. Yeah. So that's one of the boogeymen, and the other boogeyman is they're going to raise interest rates. Because we've been saying that since the early 2000s, and the only thing that's happened to interest rates is they've come down.
It's one of the most humbling parts of my entire career right there, is the predictions on interest rates. But you know what? I love the perspective that you just gave, though, because the longer you get into this business, the more history you have to look back on, and the more stories, the more ways that you can say, yeah, well, here's how it used to be. Here's what the strategy used to be. Here's what the thinking used to be. And it changes over time.
Yeah.
And that's why this topic is so important, because the tax shelters you use, the right answer can change from year to year. And your circumstances or the tax laws themselves can change. And so this cannot be just, hey, there's a right answer and you just charge forward for your entire career. You have to revisit this concept every single year with your certified financial planner.
That's right. All right, so next strategy, we've devoted entire shows to this. We'll continue to do so. It's one of our favorites right now, and that's the shoebox HSA. So who's this a good fit for? What's the strategy? Who's this a good fit for?
It's a good fit for someone who's got their budget dialed in and knows that they can pay their out-of-pocket medical expenses with cash. And in addition to that, they can fund the HSA. So in order to be eligible to fund an HSA, you have to have an HSA-eligible health plan. Mm-hmm. And there's really two choices. One is, I'm going to put the money in, I'm going to take the money out, and that's what it's all about. So you can do that, and that would be the spending HSA, or you can put the money in and leave it there. And if you did that, if you're leaving it there, you'd invest it. So you think I put the money in, take it out, that's the spending. I put the money in, leave it there, that's the investing. And because with the investing, you're saying I'm going to take that money out later and I'm going to offset it with expenses that I have, because you don't have to offset in the current year your expenses and what you take out of the HSA.
That's right. So that's the shoebox idea. You take all these receipts that you've been paying out of pocket and you throw them in a shoebox. To me, I've got a digital shoebox. I've got a folder set up in my cloud, and every time I pay a bill, I write on it, paid personal credit card, and I scan that in directly into the cloud. Will they ever audit me on that? I have no idea, but basically that's my ticket. That receipt is my ticket of saying, okay, at some time in the future of my choosing, I can withdraw that much money out of my HSA with no tax. And how I improve this strategy is that I invest my HSA and have it grow and be worth more in the future. So more tax strategies like that you need to consider coming up on the Wise Money Show with Korhorn Financial Group. All right, this next one I've got a story on. And yeah, I'm sensitive a little bit to, we're halfway through the program. We've only talked about 2 strategies. We've talked a lot about having strategies. We haven't shared a lot of strategies.
Yeah, we got to be done with tax shelters in this segment, right?
And I'd like to do a couple of them.
We do?
If we can. Well, we've got
auto owners.
Did we tell people we're going to do 5? Did you say
No.
5? Okay. We said 5.
I'm just saying I would like
Yeah, no.
have some
Let's do it.
variety.
Let's do it. Let's kill it.
So I can make the story brief. So, all right. Very interesting tax strategy coming up. If you've got a lot of dollars in a non-tax sheltered account for whatever reason, I'll explain. This is the Wise Money Show coming right here. Oh my goodness.
Yes, blooper reel.
Blooper. Reset that one. Hey.
Hey,
It's all right.
Keeping it
Happens.
real.
Keeping
happens
it real.
to the best of them.
Yeah, happens. All right, I got an interesting tax strategy right now. If you've got a lot of dollars that are not inside of a tax shelter for whatever reason, I'll explain. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, subscribe to it, turn on notifications, and you'll be up to date on all Wise Money content that we drop. All right, so the next tax strategy, we're talking about our favorite tax shelter strategies, is if for whatever reason, I can think of 2 scenarios, you have a lot of non-tax sheltered money, okay? Then using that money to either max fund 401ks and Roth IRAs, so basically use your income to contribute as much as you can into 401k, so you max it out and you live off of this non-IRA, or transferring this non-IRA directly into the Roth or your IRA to make those contributions, or using it early in retirement and doing Roth conversions. I know I threw a lot at you there, but they're all sort of connected to one strategy, and that is when you have a lot of money that's not sitting in a tax shelter. Well, how could that be? One case in particular is you inherited a chunk of money from mom and dad or a family member. Right. And a fan of the show I know is listening right now. We're working through this where we were working one financial plan and we're working it and we're close to retirement. His wife's just about to retire. And then tragically, sadly, very close to him, dad passed away. 6 months later, mom passed away. Oh my goodness, you got to be kidding. And now he's got, $250,000 now that's not in a tax shelter. Mm-hmm. And he came in just for a normal financial plan. I'm like, this is not a normal the entire financial plan changes.
For sure.
Mm-hmm.
Now, do we delay Social Security? Do we contribute 100% to your Roth 401k and have you live off of this money? Do we do more Roth conversions and pay the tax out of this money? So having a lot of money outside of a tax shelter creates a lot of tax planning strategies.
Yeah, absolutely. And it depends on how close you are to retirement potentially.
Yeah.
If you're on the eve of retirement, or maybe you've already stepped into retirement, but you haven't yet started Social Security, you haven't turned on that faucet, this may provide the inheritance scenario that you're describing. It might provide some resources that all of a sudden you can postpone Social Security even further, maybe all the way to age 70. And for many people, that's what makes the difference between them maxing out or totally optimizing what amount they'll get out of Social Security versus maybe giving themselves a pay cut permanently forever into the future by drawing too early.
Yeah.
Yep. All right. Okay. Well, so another reason why, really quick, why you might have more dollars in non-tax shelters is you weren't aware of this tax shelter strategy. You've just been funding dollars into a side account. Maybe you sold real estate, something like that. So it can be applicable a few different situations. Another strategy, and this is for you that all of a sudden looked at that boogeyman that Kevin talked about and thought that one's real. Taxes are going to be higher for me in the future. And if that's you, max funding your Roth 401k and doing backdoor Roth contributions. Let's talk about that strategy.
Well, if you're max funding the Roth IRA, that means that the
Roth 401k?
Yep, the Roth 401k. That means I'm taking $26,000. I'm assuming, I just assume that because I'm assuming you're 50 plus. So I put $26,000 in. I pay taxes on that. So when I look at my W-2, I don't have the $26,000 deduction on that. I'm paying taxes on that real time. All the growth of that is tax-free. So that is max funding the Roth 401k. And then the backdoor Roth IRA is I do an IRA contribution, a traditional IRA, if you will, after tax. And then there are two ways to get money into a Roth IRA. And you say, I'm making too much money to contribute. Then the other way I can do it is to convert. So I move from traditional IRA to Roth IRA via conversion. I put after-tax money in, and therefore when I convert, there's no tax consequence. So that gets both of those funded, and so taking the 50-plus person, I did 26 plus 7, so that's a lot of money.
It is, and it's a little, it's more next year, right?
Yeah.
Thank you for not trying to do math on the radio.
I'm not going to do math on the radio because I'm going to go, that's 45 grand. That's a lot of money.
and then your co-host will just stare at you like, I can't believe. Not that
and
I've
the
ever
other thing
been there.
that I would tell you, and I was doing this back before it was popular, back when the IRA limit was $2,000. I was telling people that there wasn't a backdoor Roth IRA. This was before 1998.
Why do I want to say okay, boomer? What, like that seems
You're
like
such
the
a
appropriate
trendsetter.
It seems like okay.
Yeah,
Go ahead.
Yeah, I can't help myself. I set trends. That's what I do. So I said, listen, put the money in after tax. You don't qualify for a pre-tax IRA. Put it in after tax. So I would still tell you, hey, if you got a couple $100,000 in an IRA, and you say, hey, the backdoor Roth IRA real-time strategy doesn't work very well, that's fine. Put the $6,000 or $7,000 into that traditional IRA, build up your after-tax IRA money there, and right before retirement, separate it like you separate the egg yolk from the egg white, and take your pre-tax IRA, throw it in your 401k, then you have just after-tax IRA money, convert that, and then roll your 401k out.
Yeah, that's like advanced planning right there. A lot of people don't even realize that you can do that. But if you didn't follow all that, rewind, listen to that a few more times because there's some important strategies there. But the people that we're talking about are folks who have resources and they want to max out how much they can get stuffed into accounts that are outside the reach of the government's hands when it comes to taxation.
Yeah.
Right?
For now.
Especially if you're worried about taxes going up in the future, then man, these tax-free accounts could be one of your best friends in retirement. So, and it may go back to that scenario you were just talking about a moment ago, someone who inherited a bunch of money. Maybe you've never been able to max fund anything in your entire life, and now all of a sudden you've got some extra resources. It may be time to do some fancy footwork and adjust your paycheck at work so you max out what you're allowed to do there. And if that makes your paycheck too small at home to live off of, then that's okay. You've got this pool of resources that you just inherited. Maybe you live off a portion of those.
All right, so here's my favorite tax shelter strategy, and I'm going to put it under this umbrella, and it is contribute pre-tax enough to get your adjusted gross income below a certain threshold, so you then qualify for more credits. Okay, so that's the overarching strategy. My favorite one beneath that, retirement savers credit. I love looking at tax returns for young professionals or people just starting out or someone transitioning into retirement where their adjusted gross income is pretty low, 60, and you can have them contribute a little bit into a retirement account, and all of a sudden they qualify for a tax credit for putting money towards their retirement. Most people don't realize this, that you can actually get freebies from the government for doing what you should be doing anyway, and that's saving for your retirement. There's some tricks with this, though. The credit is based on $2,000 of contribution per spouse. Mm-hmm. So if that means you're married and one of you puts $6,000 in, you only get a benefit of $2,000. You should have put $4,000 in and had your spouse put $2,000 in. You'd have increased your credit. There's thresholds with this credit where sometimes it's 10%, sometimes it's 50%, right? And so it also, one of the other reasons why I love this one, it defies some of the logic, because in that scenario, you're in a low tax bracket, so you should be doing Roth. Well, maybe not, because maybe you can get your adjusted gross income down below a certain number, and that all of a sudden moves your credit from 20% to 50%. I just love it. That one isn't that one so fun?
It is.
During tax season, when you're reviewing a return, you say, I got something here.
Yeah. Because fun. When you're reviewing that tax return, it's not too late to contribute.
That's right. That's right. All right. We've got questions from fans of the show. That and more coming up on the Wise Money Show with Korhorn Financial Group. That segment went really fast.
Yes, it did.
It did.
Okay.
We took what normally is a segment per, and we went, it's good stuff.
Okay, so Kevin,
yes,
we can.
Who do you want to hit?
I mean, we can pick that back up if there's other things that you want to hit, but I have two questions already in red.
To me,
Annie, are you okay?
The only thing I would do, Annie, are you okay? Hey, so no, I think the two things that I would hit would be, well, let's
get into it.
Yeah, I would summarize. I would do a quick summary.
But then Annie's email question in red up there back from a couple months ago. We can hit that one. It's connected to what we're talking about and health insurance. And then purchased a house several years ago. We got a fire spring. That one's complicated from Deborah. I think it's pronounced Deborah.
I'm sure it is.
I mean, that one, we might even just say, I presume this is how this will work, and you're going to want to talk to your CPA.
Okay.
All right.
Let's rock.
Let's do this.
All right, dude, I'm gonna go as quickly as I can, but there's a bow tie that needs to go on.
I understand.
Or Botox, whatever, that needs to go on the first 3 segments.
That's no problem.
Okay.
You and I already have pretty full lips, by the way. So I don't think either one of us are candidates. God gave both of us these enormous mouths.
All the better to kiss you with, my dear.
So whatever. All right, let's get into it. Landing the plane.
Shoe baby.
Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn. Josh Gregory just had to step out. Every episode of the Wise Money Show, catch up to it online, wisemoneyradio.com, wisemoneyshow.com, I'm sorry, or all over social media. Wherever you're at, we are there as well. Just search the Wise Money Show. Connect with us. We were going to be hitting some questions from fans of the show. Both either came from the website or through social media, so engage with us there. All right, before we transition to listener questions sponsored by Auto Owners Insurance, thank you very much. Let's put a wraps on the tax shelter strategy discussion we've been having.
The one thing that we did, well, there are many things that we didn't mention, but the one thing that I think is notable that we should mention is if you are charitably inclined and you give money, I would want to make sure you've got the right strategy for how you give. I'm gonna just give you 3 different buckets. One bucket is I'm 72 and I've got IRA money and I'm charitably inclined. You should be giving that money through I'm going to just call it a process of a qualified charitable distribution, or if we're shortening that up, call it a QCD. If you don't know what that is, you need to be talking to your financial planner and say, hey, should I be doing something with this QCD thing, giving money from my IRA directly to a charity? That's one thing. The next one is if you had a ridiculous year income-wise, and you say, hey, I'm going to tithe off of this, and I'm going to give a proportion of money, but I don't want to give all that money to my church this year because I go to a small church and it might screw things up or whatever, you can look at a donor-advised fund. So I've got a huge income this year, I put money in a donor-advised fund, I offset my income with a current gift, but I don't have to distribute the money until I decide at a time of my choosing. The third piece of giving money is I've got highly appreciated stock, like super highly appreciated stock. I would encourage you, if you're giving money to your children or you're giving money to a charity, that should not be in the form of cash. It should be in the form of highly appreciated stock, because your kids, if I'm profiling, the kids are going to pay 0 in capital gains tax on that unless they're making a ton of money. So I would think about giving money to my children via highly appreciated assets. I would think about giving money to a charity versus highly appreciated assets. And that's another use case for a donor advised fund. So those kind of 3 buckets, qualified charitable distribution, use a donor advised fund for a high income year, and using highly appreciated assets to do my gifting. Those 3.
And what about the combination of doing any of those more aggressive gifting strategies in combination with realizing more income? You said if you've had a really big income year, but you could make yourself have a high income year by selling some of that low basis stock if you've got a lot, and then coupling that with a big gift to help lessen the burden, or do some Roth conversions, coupling that with a big gift to help lessen that tax pain. So love that strategy. I mean, yeah, we help clients with that all the time. And then I think the last one I would tuck in is we haven't really talked about, for retirement and for even giving those strategies. We haven't talked about tax shelters for college. And when you're saving up for college, there's the favorite tax shelter is the 529 plan. That's the strategy. You got to rule in, or for some odd reason rule out if it doesn't apply to you. But that would be our favorite tax shelter strategy when it comes to college.
And I would say don't overlook the educational savings account, but it's easily overlooked because the features of it aren't great.
So when we were starting the program, go ahead.
Yeah, no. So keep going. When we were starting the program, we talked about bracketology. And so my challenge to you, if you're listening to this and you're like, hey, I'm kind of fired up right now, I got some energy, I want to do something, I'm on my 3rd cup of coffee, here's what I would tell you to do. I would tell you to know exactly to the penny what your adjusted gross income was last year. You can find that on your federal return. And then I would know what your taxable income is on your federal return. And those are different. The adjusted gross income is what flows to your state tax return if you are in a state where you pay state taxes. And then your taxable income is what you pay taxes on the federal side of life. And I would look, because the brackets go from 10, 12, 22, 24, 32, 35, 37. As of today, who knows, that could change tomorrow, but those are what the brackets are. And I would look and say, am I better off paying more tax in a lower bracket today than I would in the future? And that's the $64,000 question. And a lot of times, if you're listening, you say that sounds way too complicated. Then I'd say, well, then come in and walk through it with a planner. Make sure your planner is certified. But that planner, you want them to have the heart of a teacher, and have them lay it out for you.
Yeah, that's exactly right. I mean, what we've talked about. Actually, even before we turned on the cameras and microphones, I told these guys, I'm like, there's an infinite number of tax sheltering strategies. It's infinite. So this conversation could get a little loose here, but this is not advice. I mean, we're giving you some ideas. There are tons more. There's an infinite number more, and it could change from year to year. And so work with your certified financial planner. This should be one of the first things that they're helping you with, and you'll know because they're giddy. Like, they're giddy. And this is the fun part of comprehensive financial planning, is looking for ways to do what you need to be doing anyway towards your financial goals, but do it in a way that is helping you pay the least amount of tax over your lifetime. That is the primary goal there. So, all right, let's transition to questions from fans of the show. Again, thank you, auto owners, for sponsoring this segment. I'm trying to look for a document, Kevin, to help us answer this question, and we'll see. I can't find it just yet. We'll see. But this is an email from Annie. So actually, she went to wisemoneyshow.com and submitted a question right there on the website. Turns into an email, goes directly to me. Here's what she said. I'd like to know how to get the premium tax credits for health insurance. What's the income limit if I'm single? Does an IRA distribution or an inherited IRA count as income? So sort of three questions in one there, centered around premium tax credits. So let's at least hit that first. What are premium tax credits, and how do you get them?
So, and if you check Slack, you might have what you're looking for. So basically, if I'm doing health insurance, and I'm going to make it really simple. If my health insurance premium, if I'm going on the exchange and I'm using an Affordable Care Act, or some people might call it Obamacare. If I'm using one of those plans and my premium is $500, they're going to look at my income. And if my income is below a certain level, I qualify for a premium tax credit. And the way that works is I would get what's called an advanced premium tax credit, because we estimate my income and we say, well, based on my income being at this level, instead of paying $500 a month for this, I only pay $200 a month. And then at the end of the year, there's a true up. And if I should have only paid $200 a month, nothing happens. If I should have paid more, that either reduces my refund or it increases the amount I have to pay. If I should have paid less, then the same thing happens in reverse. But basically, the way that this works is, when you think of the Affordable Care Act, this is bracketology as well.
Yeah.
There are certain thresholds where they say, okay, based on your income, you should be able to afford X amount of health insurance premium. If your income is below that, we're going to give you a credit. And if it's above that, you pay full freight.
That's right. What I was looking for, and Kevin, what you shared with me was close. But what I was looking for is, they've recently changed some of these rules within some of the stimulus plans. Mm-hmm. And it used to be, in order to receive a premium tax credit, again, you needed to buy your insurance through healthcare.gov, through the exchange, and your income, your adjusted gross income, not your taxable income, but not your gross income either, your modified adjusted gross income, needed to be below 400% above the poverty line. At least they made it simple. And so for a married couple with no kids, that was around $68,000, something like that. Well, they've changed those rules, and now your income can be even above that, and you can still get some premium tax credits. But obviously, the premium tax credits start going away. They start phasing out, because basically the government has determined what affordable is for health insurance when you're buying insurance through healthcare.gov. And that is, you shouldn't spend more than 8.5% of your modified adjusted gross income for health insurance. That's what they've deemed. So even if your income is above 400% above the federal poverty limit, you could still get some tax credits now, some premium tax credits now. But if your income is way above that, that'll start getting phased out because 8.5% of a big number is a big number. Now, let's go on to the next question that she asked. Does an IRA distribution or an inherited IRA count as income?
Yes.
Yes, it does. It's
Absolutely.
modified adjusted gross income. So listen, income is your wages. Income is also capital gains. It's your dividends. It's your rental income. It's your unemployment income.
It's your part of Social Security that's taxable.
It's your Social Security, yep, and your IRA withdrawals. And so that's the tricky thing. If you're looking at healthcare.gov, Affordable Care Act insurance as your bridge between workplace health insurance and Medicare, and you say, but I've got to get income as well, so how can I get enough income and still get a lot of premium tax credits, really cheap insurance? Right. That's the $64,000 question that you've got to work with your CFP on. We're doing lots of creative planning, solving that very issue for clients. It's a lot of fun. It's just, it's tricky.
Yeah, and the interesting thing is there's really two ends of the spectrum here. One is the younger folks, and the one of the interesting things is the younger folks that are younger than 26 who say, I can still stay on my parents' plan. Should I hop off of my parents' plan and get onto my own plan? Well, there are advantages and disadvantages of both. And then the other is the 58 to 65-year-olds who are saying, hey, I want to be either retired or mostly retired. Help me figure out what I'm going to do for health care.
Yeah, and so that's where, and the tricky thing is, like you said, Kevin, this gets reconciled on your tax return, but your proactive planning is so important through this because once you get to about now in the year, it's often too late to make a lot of adjustments to your income, but work with your CFP on that. Great question, Annie. All right, that's all the time we have for today. On behalf of myself, Kevin Korhorn, Josh Gregory, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.